All right, guys, we are back. Our 2023 real estate market forecast. We are in the month of May. My God, where does the time go? So here we are. We're going to jump right in. Today's video might be a little longer than some of the previous ones just because there's so much stuff going on. So this is me, Lance Martin, Coldwell Banker Town and Country, DLD Partners, your host for the next half hour or so. So as always, this slide is the same slide and the same QR code that we used at the market forecast. So if you already have that, it will live on forever. This slide gets you all the presentations, all the decks, everything. So if you don't have it, pause the screen, take your picture, and you've got everything you need from here. I brought Chris's mugshot back up because you may not have seen, I shot an in-studio interview with Chris. It's now about 3 weeks old, but if you haven't seen it and you want to see his updated forecast, which was about 3-4 weeks after the one we did on March 15th, so it was middle of April, you can go back to this QR code and the link to Chris's most recent interview is there. So let's jump in. I'm going to start off with some news of interest. I generally have stayed away from these because there's just so much stuff out there, but since we did our last snapshot, there's a lot of interesting things out there, and they all tie into the local market, LA, Riverside, San Bernardino, and Orange County information that we're going to be talking about here in the next 30 minutes or so. So I've got a couple of charts. So Case-Shiller, if you're not familiar with Case-Shiller, they've kind of are the gold standard in the real estate industry as far as kind of projecting what the market's doing. One of my challenges with Case-Shiller is it's always dated. I like to look at stuff and I like to think, hey, my data is like a couple weeks old. All the stuff I share with you today is May 10th, by the way. We're looking at data that's 10 days old. And it's accurate, at least for our local market. Case-Shiller tends to look at stuff that's 90 days old. So I generally don't bring it here, but I'm bringing it to you today because it basically bolsters and ratifies everything that we've been talking about. So what you're looking at here is basically January 2022 through February of 2023 Case-Shiller price indexes for the country. And if you just kind of notice the red bars, these are prices that are starting to soften. If you listen to my interview with Chris Thornburg, I used the term price destruction in that interview, and he immediately slapped me and said, Lance, do not contribute to the narrative and be a little overly dramatic by using the term price destruction. So whether you want to call it price destruction or a little bit of a pullback or whatever your term is, these red bars are basically deceleration, price destruction, pullback in price, whatever, nationally. So started back in July and basically continued through January. And then the headline, and the reason I'm showing this, and if you guys have been following any of the financial folks or the real estate folks on Twitter or Instagram or whatever, you may have seen this chart from Case-Shiller. And the headline is February 2023 national prices ticked back up. Not a whole lot. 0.2%. But anyway, ticked back up nevertheless. Why am I making a big deal about it? Only because it pretty much matches almost identically with what we've seen. Although our charts also include February, March, and April. So we get a little bit more data. And in effect, it continues the trend. So we saw that downward slump in property values, and we appear to have seen some stability at least since, call it, February, according to Case-Shiller. And that certainly jives with what we have. Similar chart, this is actually put up by a company called Black Knight. Black Knight is a big data aggregation company. It actually ties in perfectly to the Case-Shiller chart. And what you're looking at here is you've got two circles. November of 2022, the red portion, 96% of the pie chart, represents, this is nationally, home prices declined in the 50 largest metros in the United States. So the 50 largest communities throughout the United States in November of 2022, 96% of them saw prices declining. Fast forward 4 months later, this is 1 month ahead of the Case-Shiller chart, March of 2023, basically a month before last, and now you have the exact same 50 metros showing 92% of those areas have price appreciation. So at least for the moment, we seem to have kind of stemmed the slide downward, and we've actually seen some stability in the marketplace. Those two charts jive 100% with each other, and they certainly jive with everything that I'm going to be talking about and the remainder of our presentation today. And again, two different organizations, Case-Shiller and Black Knight, and I respect both of them, otherwise, of course, I wouldn't have this data. This is interesting. This actually came out straight from Fannie Mae, and Fannie Mae is, in effect, what they're showing here is consumer confidence in home prices weakening. So in other words, the consumers are saying, oh my gosh, prices are not doing so great. We're seeing a weakening. Well, again, jives exactly with what we just showed on the previous two charts. In 2022, the concern, 37% of people are concerned about it. Well, they should have been concerned about it, because if they were paying any attention, basically from, through the summer, through the third and fourth quarter of 2022, we saw those prices pull back. So that makes perfect sense. And then this is an interesting one, though. This one kind of surprised me a little bit, and it's maybe changing my feel just a little bit on where we are in the market. And optimist, but not just for the reason of being optimistic. But what we're looking at here, the far right chart, your right, my left, shows, this is from Showing Time. Showing Time is a program that tracks showings by real estate agents, electronic, those little blue lock boxes that you see on the properties. And the program kind of coordinates with those, and it says, these are basically buyers real estate agents scheduling showings for their buyers. So you've got the relatively large black chart. I don't even know what the 223.9 represents. I'm not paying any attention to that. I'm just looking at the size of the bar. And these are the number of showings that the system was using, agents and buyers looking at properties. Now, what they've labeled it, I kind of like this. They've labeled 2021 and 2022 the pandemic unicorn years. It's been crazy, crazy years. Quite honestly, I probably would have moved that forward a little bit, and I would have called 2020 one of those years, because obviously that was the initial start of the pandemic. But the first part of that year kind of got lost. The second part of that year exploded. But the point that this chart is making is, for all of the concern about real estate and interest rates and buyers' interest and are the buyers engaged and all the rest of that, what this is measuring is March of these years, March of 2017, March of 2018, 19, all the way to 2023. And the buyer interest in March of 2023 was actually higher than the prior 4 years prior to the pandemic years. So the buyers are there. We might not like the interest rates that we're looking at today, because they're certainly not those 3% interest rates, but they're still engaged and they're out there, which should, if you're in the real estate industry like me and we need to sell some houses, then we kind of like to see that. That kind of makes you feel good. So, however, we still have this transactional problem. This is a slide that I pulled out of our market forecast presentation, which is just trying to represent where are the transactions. So we have the buyer demand, but quite honestly, the seller participation in the marketplace is tough, so we're still struggling with transactions, and of course that continues to be the theme. One last thing for those of you that are still worried about, oh my gosh, we're going to have a lot of short sales, we're going to have a lot of foreclosures. This is another chart that popped up from Black Knight. Again, Google them, check a look at them. Their information, their data is fantastic and very reputable. And this is one of the things I think that Chris Thornburg and some of the other economists are saying, as far as, don't worry, we're not going to have a significant number of foreclosures or anything close to what we've seen in the past, because of the amount of equity in the homes. And if you can't see the little number at the top of this chart, it's $9.3 trillion in homeowner equity in March of 2023 compared to prior years. This goes back to 2005. By the way, all of these slides are available. Just follow the QR code and you can see these exact same slides. They're all there for you to take a peek at. By the way, this represents only the 80% of equity available. So in other words, if I was to refi my property, I would still have that 20% equity on top, because you're generally not going to want to refi above the 80%. I mean, you could, but it's going to cost you money. So the amount of equity is actually even larger than this, because this takes off the top 20% of equity all these homeowners have. So these are big, big numbers, and we just really have to see something catastrophic to put us back into 2008 situation. So you take that for what it's worth. We've been saying for a while, relax, we're not going to see these massive foreclosures. Having said that, my office does have some short sales. And the short sales that we're dealing with right now are all people that purchased in the last 12 months, and something has changed in their life. A divorce, some sort of financial issue, whatever it happens to be, and they want out. So I do think we'll have a few short sales for those people that got kind of caught up with that. Wouldn't be a market snapshot without a little homage to Chairman Powell. We did see another 25 basis point increase last week. I think it's kind of beginning to feel like he might be done. There's a lot of stuff going on in the marketplace right now, but it feels like we might be done with that. Maybe we'll just see the next couple meetings with no increase, a little bit of a pause. People are already talking about rate cuts. I don't care about any rate cuts. Just leave us alone for a little while. Let us settle in with their interest rates. If they do cut it, so be it. But possible we're done, okay? I guess time will tell, and we're going to find that out. So let's jump in. A little bit longer of a windup than we've had in the past. So like I say, today's snapshot's going to be a little bit longer. So let's jump in with LA County. I am going to take some more time going over these charts because there's some interesting things happening. And for those of you that have been following this, I want to make sure you look at what we're looking at. So this is median price, 2 years, LA County. Again, we can kind of see this little rise and this little dip. We'll spend a little more time talking about that in a minute. This is the 12-month chart for LA County. One of the things that we've been following now for almost a year, we probably didn't really start focusing on it till about 10 months ago, 9 months ago, but it was when did the markets actually peak in price? Well, a year ago, we didn't know we were in a peak. We just, hey, this is where we were. Oh, hey, we pulled back a little bit. Hey, we pulled back. Is this going to continue? Well, it's been almost a year of that. So for LA County, single-family properties only, that's all we're looking at here, property values peaked in April of 2022. Okay, so April 2023 is now, or at least last month's numbers. So we peaked basically on a month-over-month basis, April 2022. There it is, okay? It's going to be a little bit different in some of these other counties. I think one or two of them also peaked in April, another one peaked in May, I think one might be in June. We're going to see them in a minute. The reason I want to point that out is, as you've seen over here, as property values have stabilized and we've actually seen an increase in values in the medians, we've been saying, hey, it's stable. It jives perfectly with the two charts I just showed you a minute ago from Case-Shiller and from Black Knight. We are basically trending like the rest of the country. Okay, I suppose that's good. But as this is peaked here, assuming these values, oh, by the way, I'm skipping ahead. That's an 8.6% drop in median price from April of 2022 to April of 2023. That's the number, minus 8.6. So, in theory, as we move forward and these bars get a little bit smaller, and that bar over there on the other side, the current month, either stays the same or maybe goes up a little bit. Hopefully it's just a little bit or just flat. This 8.6 number is going to get smaller and smaller and smaller. And then in theory, when we get to the end of the third quarter, beginning of the fourth quarter, we'll be at a flat position. So there you have it. LA County, we are basically at the peak 12 months ago. I do think you're going to find some interesting stuff with that as we move forward the way this stuff is reported. So what does that mean? $835,000 is the median price. 8.6% less than a year ago. A year ago it was 914. The smallest number on here that's positive 2.9%. I'm going to point to this number on every single one of these charts for the 4 counties and for our little spotlight city, because this is the 2-year number. So for LA County, median price is still positive from 24 months ago, and the number is 2.9%. So if you kind of stretch this out over a period of time, even though, yeah, we got 8.6% negative, over 2 years, we're still positive. We're in the black and we're doing okay. So again, for LA County, peak to current, it's the same. That was the peak. I have not done the year to date yet. It looks like I'm going to bring that in. What did I say? We'll start to track next month. So next month, when we do our June snapshot, we'll basically start doing from January 2023 forward. The numbers have been, at this point, I don't think they're really relevant. So, but we'll start tracking the year-to-date numbers starting next month. So there's LA County, supply and demand for LA County. Our lady looking down at those ever-smalling number of transactions, well, here we are. So, as much as I feel good about where we are with the prices and stability and the buyer demand, the red bars are still inventory. I was talking with a friend of mine about normal markets. I don't know what a normal real estate market looks like. I've been saying, boy, we're back in a normal market. I've been saying that for 15 years. So I guess I got to stop saying, a normal market. But for now, for these purposes, these bars going up, December, January, February, March, every year pretty much in a normal market, you start to see inventory come on the market, sellers engage on the market, and it's pretty much been that way for the 35 years I've been in this business. And it kind of starts in December, January, and it rolls through sometime in the middle of the summer, July or August, maybe June, July or August, and then we start to pull back. We have not seen that. So we peaked last August, and every single month from August of last year, inventory has gotten lower and lower and lower. And that's why if you're in the real estate business or the mortgage business and we make our living on volume and transactions, we're all crying because we need more transactions and we're just not seeing the sellers engage in this market. So all the charts look the same. I know it's a broken record. Second part of these charts, I've added two more. Actually, I didn't add two, I added one more. The blue bars are pendings and the green bars were closed. We'll talk a little bit more about those when we get into the other counties. This is the 12-month chart for the same stuff. We can skip right past that. Our month supply of absorption rate, LA County, is 2.4 months. Chart looks like there's not a lot. It's the biggest number of all the counties. The supply of inventory is just horrifically small. So, but also, what is that doing? Small inventory, buyer demand, even with higher interest rates, it's keeping property values where they are. So homes for sale, 20% fewer than a year ago, 24% fewer than 2 years ago, 2,400 properties in escrow, 20% fewer than a year ago, 35% fewer than 2 years ago. I've been emphasizing these numbers for the last several months. Oh my God, we're selling 35% fewer homes. Oh my God, we're selling 50% fewer homes. Those are bad numbers, bottom line. They are bad numbers. We need to get more transactions going. However, if you've been paying attention to those, as we move forward through the next several months of our presentation, those numbers are going to start to change and they're going to start to get smaller and smaller and smaller, which in theory is good. But the reality is we're going to be comparing some small numbers to some smaller numbers because we're starting to catch up with ourselves. So we shall see. I do think if you're in the real estate business and you're dependent upon transactions, it's probably going to be a bumpy year for the rest of 2023. That just seems to be the trend. I think values are going to be fine, but at the end of the day, I just think the transaction volume just isn't there. The sellers just are not engaged for all the reasons we've been talking about for months and months, most of that being those sellers have very low interest rates on their homes. So let's hit Riverside County. Again, similar looking chart, values still stable. The far bar to the far right is an increase month over month. This is the 12-month chart. You'll notice we have not hit peak, so you're going to see that in a minute. Matter of fact, our next chart is our current to peak. Current to peak is June for Riverside, and that's where we are. That's a 5.8% decrease. We'll talk about that here when we get to the bigger chart. So 5.8% decrease, peak to current, so that's June to April. Last 12 months, 5%. If you remember with LA County, just 4 minutes ago, I told you to keep an eye on this lower bottom number. It was like 2 point something, I think, 2.9%. Well, with Riverside County, over the last 24 months, we're still 11.4% to the positive. This is why I just don't see any dramatic bad stuff happening from a pricing standpoint. So, so what's that number? Basically, let's call it 479 on the current medium. A year ago, oh, excuse me, I said 479, 579. A year ago, it was 600. That's where we come up with the negative 5.1%. And 2 years ago, it was 520. Supply and demand on Riverside, frankly, it looks just like LA. Just that cratering number of red bars, just nothing for sale. But the demand is what it is, so we just continue to see listed inventory drop. I can't remember what I said last month. I don't know if I made a prediction. I guess I have to go back and take a peek at it. I think I said maybe it would go up, but I wouldn't bet on it. Well, if I said it was going to go up, I was wrong. It went down, continued to go down. We'll see what May holds for us. Supply and demand, 1.4 months of inventory, of standing inventory. So in other words, all the houses that are currently for sale, at the current demand rate, the buyers interacting with them, it would take 6 weeks. If no other properties came on the market, every single house would be sold. In 6 weeks, we'd have 0 houses on the market. Very, very small number. So where are we? Homes for sale, 4,200. That's 16% fewer than a year ago, 7% fewer than 2 years ago. And then here's our transactional numbers. The pendings are off by 18% last 12 months and 25% in the last 2 years. Same story. Let's jump into San Bernardino. San Bernardino, again, I use median price I guess I'm just tired of explaining it, but I use median price. We do get some fluctuations periodically. San Bernardino median pulled back a little bit. You know, it was kind of trending upward. Well, we pulled back a smidge in the month of April. San Bernardino, like LA County, peaked in April. So we've kind of seen that high water mark, and now from this point forward, we're going to kind of continue to measure off of that. So we did see a peak 12 months ago, 8.5% from 12 months ago, 480 now, 525 12 months ago, 450 24 months ago, and I'm going to, again, for the third time, point to this number if you can't see it on the screen, 6.8% positive. So the property values 2 years ago were 450. 480 is 6.8% higher than it was 2 years ago. So again, we're doing okay. And again, from peak, we're at 8.5. San Bernardino County supply and demand, it's the same stuff. It's a broken record. No sense in the charts look identical, I promise. They're accurate for each county I'm pulling up. But we've got those cratering red bars, and they are what they are. 1.7 months supply in San Bernardino County. And what are we looking at? 4,800 houses for sale, 15% fewer than a year ago, 16% fewer than 2 years ago. 1,500 houses in escrow. San Bernardino County is a big county, okay? 1,500 houses sold in the entire county of San Bernardino. It's just a small number. 13% fewer than 12 months ago, 32% fewer than 2 years ago. I've reinserted Orange County the last few months. I've kind of ignored Orange County. I don't do a lot of business in Orange County, but I do think it's important, as we can see, because that market does impact what we do in the Inland Empire. So I'm going to continue to throw Orange County in here. Little bit of a pullback on median last month after pretty good rise in the month prior, but at any rate, it is what it is. There's your 2-month chart, which, by the way, is also the peak. So if I had that right, LA County, San Bernardino County, and Orange County all peaked in April. So we're going to start. We're past that. Riverside County, I think we just saw, was June. So that's our peak. And what does that mean? 7.7% from peak. A lot of people in Orange County were freaking out a few months ago because that number was significantly bigger. I think we had a chart, 14, 15% pullback in Orange County values from the peak to where we were. Just to go back a couple of charts, well, that was here. This is where you had a lot of people freaking out in Orange County. Oh my God, we've seen a 20% drop in property values. Okay, well, if you want to compare this one to this one, okay. Well, we seem to have backfilled that here a little bit, for better or worse. So anyway, just go back to where we were. So there's our numbers, our supply and demand numbers in Orange County. Again, same thing. Not quite as dramatic, actually, as far as the units for sale. It almost feels like we've seen a little bit of stability, and maybe next month we'll see a little bit of increase in values. We'll see. 1.4 months supply of inventory in Orange County. And here's our numbers as far as the listings. 22% fewer listings a year ago, 36 from 2 years ago. And the pendings are, again, this number here is just a killer. 44.8% fewer homes in escrow than 2 years ago. I think last month that number was close to 50%. So at any rate, we'll see. Prices are stable, transactions are down, same thing. So I pulled up Rancho Cucamonga as our spotlight city for today. Small data sample, so it's a little surprising how well Rancho Cucamonga's done, but the number of homes being transacted in the city are pretty small. But anyway, so the price certainly has stabilized. You see more choppiness here. It's just a smaller data sample. That's why you get that. There's our 12-month chart for Rancho. So what are we looking at? 780. It's only off by, call it flat, 0.6% from 12 months ago. 780 compared to 785. 2 years ago, 695, which again is 12.2% up. So if you're in Rancho, you're feeling pretty good. I guess and even if you bought a year ago, you're feeling good. Your value's flat. Nobody's going to say anything about a 0.6. I didn't do any peak to current or year to date in Rancho. I just left that be. We'll deal with that later. But look at that, same exact issues with inventory. The red bars, active listings down. I will tell you the difference is the demand in Rancho is huge. I mean, it's almost 50%. Actually, it's more than 50%. You're going to see that in a minute. So that's the 12-month chart. You can pull these if you want to take a look at it. By the way, real quickly, if you're in a community that I don't do this on, and you're like, Lance, what about Costa Mesa? Or can you get me Long Beach numbers? Just call me, text me. Maybe I should probably say this at some point earlier in the presentation, now that we're 25 minutes in, and who knows how long you made it. Guys, we sell real estate, okay? Coldwell Banker, Town and Country, myself and Drew and Drake, and yes, we're brokers, and yes, we're owners, and yes, we manage agents and manage properties and all the rest of that sort of stuff. But we're real estate guys. I just don't shoot these videos just because I want to see myself talk. We've had people that we know that have actually listed their property or purchased their property through somebody else. And we talk about, dude, what's going on here? You know, and they're like, oh, you're still doing that? You still actually list and sell? Yes, we still list and sell. And if you're not specifically in the area where Drew or Drake or myself can help you, we've got 200 agents. And we're going to connect you with one of those agents, and we're going to take fantastic care of you. So hey, there's my little commercial. List with us. So where are we? Rancho Cucamonga, supply and demand. Not supply and demand, month supply of inventory, 0.8 months. So let's call that, what, 23 days, 24 days of inventory? There's nothing. And just to drive that point home, yeah, there's nothing. There's 177 houses for sale in the whole city. Those are single families in the whole city of Rancho. Last month, 88 properties went into escrow in the whole city. That's a small number. So if you're an agent and all you do is Rancho, unless you're the dominant king in Rancho, that's a very small pie distributed by, frankly, a whole bunch of agents. So let's wrap up with interest rates, and then we're going to get you out of here today. So here's our optimal blue chart. Again, I want to take a pause here for a second, and we're starting to stretch these charts out. So this is May 9th. This chart actually, it's always a day behind, so this is May 8th. Today's the 10th, so it's a couple days behind. But this is a 12-month tracking of interest rates. This is, let's just call this November. Since November of 2022, we've kind of floated down and up and down and up and down and up, and now we're kind of in that mid-range, call it 6.5 plus, 6.5 minus. But we're a lot of consternation about interest rates. And you got people like me yelling at Chairman Powell, and what are you doing in the economy, and blah, 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 blah. Well, we've kind of settled into this range. Okay, we have been consistently at a north of 6% interest rate now, bumping on 7% back and forth for 6-7 months now. And this goes back a year ago. And a year ago, we were in the 5.5s. So we have been now in a interest rate trading range, let's just say north of 5.5% for 12 months. I think we're starting to acclimate to that. We can still talk about the good old days with the 3% interest rates, but those good old days are becoming older days. So we've been a year now at north of 5.5% interest. Be nice to see us get back closer to that low 6, maybe a high 5 rate. Is it coming? I don't know. But anyway, this is the optimal blue index, which, by the way, that said basically 6.5%. The reality is most of the people watching this video right now are not going to get a 6.5% rate. If you go to the old Google machine, this was as of yesterday, $500,000 loan in California with the FICO around 750. You're probably looking closer to 7, okay? Depends on a million factors. If you need help with that, call me, okay? I don't do loans, but call me, and I will connect you with one of our preferred partners, and we'll make sure whoever helps you with your loan is going to get you a good loan, and you're going to get the best rate that you can qualify for. So, so there we are with rates. We're basically done. That's our May snapshot, a little bit longer than normal, so thank you for you guys that stuck with me. All of the charts are available. Just scroll back to that QR code, and you can see those as well. And I will see you next month.